On the podcast with us today is Garrett Lynch. Garrett, welcome to the podcast.
Thanks, Dan. Appreciate you having me.
Well, Garrett, I want you to get us started and to share with the listeners a little bit about who you are and what your background is before we start diving into this 218-unit property out of Little Rock, Arkansas called Crestwood Manor Apartments.
Sure. Yeah, I've been an investor actually since 2011, general partner. And at one point at my first company, I started in 2013. We had acquired close to 3,400 units in 10 markets across the country. I actually sold out of that portfolio at the end of 2016, partnered up with some new guys, and we started acquiring some more projects. And the first one that we did pick up this year was a 218-unit deal in Little Rock, Arkansas. So I've been doing this for a little while, and this was a pretty good deal. I'm pretty excited about it.
Well, let's dive right in with this one because most of my listeners know that I just dive right in and start asking questions. So you obviously have not seen these questions, and none of our are not our listeners, but none of our people who come on and guests actually have any of these questions ahead of time. So I want you to get us started, Garrett, and talk to us about how did you actually find this deal?
So this particular deal was made aware to us. We actually have my partner has a program where we kind of give our criteria out and people will hunt for specific deals. Now, what I do a lot of the times, I find deals and source them. And the way that I do source deals is I have obviously my own network of brokers that I work through. And then I have a list of all the websites of all the different brokerages. Because a lot of brokers now are keeping all their deals on their websites, which I have a VA comb through, pull out the ones that are going to make the most sense for our criteria, and then we have them underwritten, or I'll underwrite it myself. But this one was actually brought to us by a student, and we got it, and I was like, okay, this is a deal. Someone else had actually, this is actually a really good thing that I think everyone should pay attention to. But sometimes deals go under contract or they're gone, and if you don't put in your calendar or put somewhere that when that deal is supposed to either go hard or go under contract or something like that, you're really doing a disservice to yourself, because they can pop out of contract, or they can even not go under contract. And then you want to be the first one in that broker's mind to get into that deal. And so that's kind of what happened with this one is somebody else won it essentially. And then they weren't able to put in their contract. They weren't able to come to terms, or they switched their terms, and they came back to us to get this deal. And then a couple others actually. And so we had to recompete for the deal, and ended up winning it based on our track record. And, another deal that we had done with the same broker in a similar market. So, it was all around just keeping with the deal and sticking with it through the process. It took probably about 6 or 7 weeks just to get it under contract, but it was worth it. Because now this is a killer deal that we have and we own or we're managing. So it's a little bit of background on the origins of this deal.
Sure. There's a lot of golden nuggets that you just kind of threw out there, and I want to make sure that the audience listens or picked up on a few of those things. So I'm going to ask a couple of follow-up questions to some of the things that you mentioned. So the big thing that I think a lot of people should have understood here, or should be picking up, is you put an LOI, a letter of intent, on an asset, and you lost the deal because somebody else came in and actually outbid you. And whether they outbid you or they had a better track record or whatever the better terms, the seller chose them instead of you. And then you said, well, we're going to still continue to follow up with this deal to see if it actually falls through. And so talk to us a little bit about that piece of it, because I think that's very important for the audience to understand is what are you doing in that follow-up, and how do you know how soon to follow up? Are you going through with the broker, or are you just kind of, checking in on a certain time frame, 30 days, 60 days out? What's your process like?
Yeah. So in the beginning, let's just say you lose a deal. So it's gone. They're like, all right, hey, we awarded it to someone else. So you mark that down in your calendar. Okay, this is, this is when, we lost this deal, and you assume that probably it's going to take 7 to 10 days for them to get this deal under contract. Okay. So, to have like a follow-up point, at least like about a week later with the broker, and just be like, hey, how's everything? You just check in with them. Okay. We really still like this deal. If they can't put it together, we'd love to step in. So you have like your 7 days out. There's a date in your calendar for that. And then I'd even do it at 10 days out as well. Okay, so you're checking in with this broker at those dates to stay in their mind. Now, if it does end up going under contract at that time, that's fine. But keep in mind, they probably have, you want to find out from the broker, like, hey, how long is their actual review period? Just curious. And they'll tell you, and they'll be like, oh, well, yeah, it's like 30 days, which is normal, right? So marking it again in your calendar 30 days past that. So in the event that they can't materialize, let's say the materialize a contract, does go under contract, 30 days out from there, they're going to go hard or they're not. And if they don't go hard because something happened and it falls out of contract, you want to be right there in the mind of that broker again when it falls out. And so that's another really hard date, that you want to pay attention to. And I've gotten deals that way, where it falls out before you're next up. Now there's less competition or no competition because you've been squeaky wheel, and now you're right in alignment to get that deal set up to you. And so on this particular one, it got to like day 10, I believe. And then they couldn't materialize the contract, so they came back to us, and then they had another kind of bidding process in it, but it wasn't as competitive as it was initially. And so we were actually able to come ahead and win it.
So that's going to be my next question in here too, is how many rounds of offers did you go back and forth, and how many people were you competing with, and what was that process like?
Yeah, so when we asked to come back in, I guess we were having, so they restarted the bidding process at that time. I think it started out with about 14 groups, and then ended up, they always have the initial offers, and then you kind of find out. Like what I always do in the bidding process, which I think is important, is I try to get as much intel as I possibly can on the other groups that are also bidding, so I understand, who I'm up against. And the brokers, sometimes they will tell you, sometimes they won't. It's just kind of a luck of the draw thing, but you can ask questions that are kind of general that will give you some answers. It's like, so, hey, just curious, where are these guys, where are they thinking that they're going to be as far as, their due diligence period is? Is there any hard money out there right now? If there is hard money out there, how strong is that particular group from a buyer standpoint, in your opinion, personally? There's stuff that you can ask that's general. It doesn't maybe pin down one specific person. They might feel a little uncomfortable with those questions, but it allows you to get a bit of an edge when you're trying to win these deals. So you kind of know where to come in at and where to land things. And I guarantee you they're doing the same thing against you. So in this process, there were a total in the best and final of like 5 groups. And we ended up having it was $50K less than the top group. But the big thing that we did is we leveraged our contacts into this deal, and we made sure that all of our references and our track record were very positive. So it put us in a very positive light. And I think what ended up winning us for this one is we had closed in February a deal with the same broker in Memphis, and it went completely flawlessly. So if you ever have a flawless acquisition where it's just like, bam, everything goes perfectly, leverage the heck out of that, because that is so important, especially if you can tie that to the next deal somehow. That's what we did on this one, and that's what helped us edge out the other groups and actually win this deal. And then you can even get it for less, because sometimes you want to see what's most important to that seller in the process. That's another question I ask, is like, hey, what's more important? Obviously price is important, but are these guys just trying to get this off their books? Are they trying to make a good profit on it? What is the most important to them? Find out, and then position your LOI and your offer into what they want. Think in terms of what that seller is going to want the most, and then just do your best to try to win it.
And obviously, once it got to this point where it was kind of the second rounds of offers, I guess, or second rounds of best and final, at what point prior to that did you guys end up actually touring the property?
Yeah, so we toured the property on this particular one. We went out there initially just to do the, you have to see the property first before you can really be in the best and final. So someone's got to go out there, some decision maker. And I highly recommend doing that, even though it's kind of, you may not have won it yet or anything like that. It can give you a big edge on the property, the market, and FaceTime with the broker. And so we went to see this one actually, as we were going into the best and final. So they said, listen, you're going to be in the best and final. You need to get out to the property, check it out. Went out there to check it out at that point, make sure that everything was, we put the FaceTime in, we did the property walk, did everything that we needed to do to put ourselves in the best possible position with the seller to win the deal. So there's the worst thing you can do is just, not want to spend the extra money to go to the property and you're in the best and final. And now that's why you didn't win it. So that's the first time we went. Yeah.
So was there any hard money? And again, for the listeners, hard money, we're not talking about a hard money loan. We're talking about earnest money deposit that goes hard or is non-refundable day one or even after due diligence.
So this is actually really popular right now just because of the highly competitive market that we're in multifamily. I mean, hard money is everywhere. And the deal that we're doing right now, we had to put hard money up day one to win it. So I think that it's challenging to not have to do that in this particular deal because of our track record on the previous deal. And because I think of the market that we're in, we focus on like secondary markets that have good fundamentals going on in those markets. There's not as much hard money. So this one, we actually were able to avoid that for the first 30 days, which is kind of rare, but it was a good way. If you can avoid doing it, I would say, obviously it gives you more leverage on the entire situation. If anything pops up during due diligence and you need to negotiate or something happens. So like on this deal, we had a little bit of a hiccup where the occupancy dropped. So it was at like 94% when we went in and we were getting a Fannie loan and it dropped down to 88% in like 3 weeks. So because we didn't have hard money and we had a better time negotiating that. So yeah, this one we were able to avoid that.
And after the due diligence period, how much did you end up having to put down?
So this deal, it was $100K hard after 30 days. It's about $11 million transaction. I think we had 100,000.
And what was that? What was on this deal? The time frame from the time the LOI was submitted to the time the PSA was signed, roughly.
That time frame was, I try to do that in the first, I'd say 10 days typically. I think this one took 10 days. So we had a few things we need to iron out in the PSA, and that whole process is a negotiation in itself. Just trying to get everything. The LOI is just so it's basically a very basic outline of what you're about to get into in detail, and then you get a PSA sent to you from maybe the seller or you have it written up, and you just got to go back and forth on that a few times to get it, looking in your favor as much as possible as the buyer, but not upsetting the seller.
So you got this thing under contract after that kind of LOI phase of going back and forth to the PSA. You didn't have to put any hard money, due diligence money, or not due diligence, but earnest money deposit day one. But obviously after that due diligence period, which was it the standard 30-day due diligence?
Yes.
So had that 30 days of due diligence. During that due diligence process, were there any issues that came up that you remember?
So the only thing that came up was the occupancy. So the one thing you got to watch out for is, and now we protect ourselves inside the PSA with this, but if you're trying to get a loan that is agency, they require that you show a rent roll that's a minimum 90% occupancy, like 3 weeks prior to closing or within that, that kind of a time frame. So if you're in or under contract with a seller and they lose their occupancy, or sometimes they'll just want to save as much money as possible and they won't operate the business as it should, and things will start to underperform even in that 2-month time frame. Your occupancy could drop by a bunch, and now you're essentially not even buying really the same product that you signed up to buy. So you got to be careful of that. We put a clause in our last deal that said the seller would not allow the seller to go below an 85% occupancy. They're at 95 now. So if they drop more than 10%, they're in breach of contract. So that was the big issue for us, is that they went from 94 down to like 88. And we had to basically say, listen, we're not going hard until you guys put this back up to 90%, just so we can show the lender we got to check the box and move forward. And then they were, it took a little bit of, negotiation on that, but they agreed to do that.
That's a very big tip there, to make sure that you put in the PSAs, especially before any money goes hard, or even if money is hard, that you can get that money back and it doesn't become hard, or it becomes refundable at that point if the actual occupancy drops below, especially for those agency loans. But I would still put it in there, even if you're considering the bridge option, because if that occupancy drops below that, that means your economic occupancy is going down way far below that. And they can also cut proceeds pretty significantly, which can change the entire dynamics of the deal. So that's a great tip there.
And I heard that, like, this is the worst case scenario, but there's a recent transaction that I heard about where the guy actually pulled the entire staff off the property while it was under contract, just completely took it out. See you later. You're done. And they had to go and close this thing, and the occupancy dropped significantly. Not to mention the whole business was, going crazy at that point. So things can happen.
So the property itself, no issues, just the occupancy really kind of was what came up with it.
That was really it. Nothing major that was outside of our scope and what we thought was going to, happen. And so that
they always find something.
Yeah, you always find something. I mean, there's the big thing. I mean, the way you can lose on a deal is if you're undercapitalized, and if you're buying it way too high and you're undercapitalized, and then maybe you put yourself in a position where you have this fixed debt with a huge prepay on, and let's say the operation goes to complete trash, and now you don't have enough money to fix it. That's how you lose. Now on this deal, we had a ton of money that we had ready to go and ready to inject into this deal, that if some things were off a little bit, didn't really impact us too much. So there were things after we closed on the deal that came up, maybe we had missed, but then there were other areas where we were saving on. There's not always a perfect science. You try to do as best you can on that. But as long as you have enough in the reserve to make sure that you can cover that, I think that's a big key to make sure these deals work.
So let's talk about and kind of shift here into the financing part of this. We've already kind of hinted as well that you did a Fannie Mae agency, debt on this. What were some of the terms that you received on this particular debt?
So I'm actually excited to talk about this one, because this was like the perfect storm, this debt piece. So we had a decision to make. We were like, okay, we're going to do bridge on this deal. We're going to come in with the agency. And so I got our initial term sheet, and it was Fannie Mae debt, but because the cash flow was so strong in this deal, the DSCR was so high, they were able to give us some CapEx dollars and cover closing costs on this particular deal as well. So it was 75% loan to cost, essentially, which means that they're willing to give us, again, the closing costs and then about $1 million towards our CapEx budget, which was great. And the total purchase price in this deal is $11.25 million. And our total CapEx budget was about $2.2 million. And so what they did is, we had 180 over the 10-year treasury, and we're getting into the nitty gritty of the loan. And I had the option to extend this loan, because you got to think about the loan that you're getting into. What is your exit going to look like? I think too many people don't look at the exit and understand, all right, what is this actually going to look like when I go to sell this thing? And they get into like these long-term agency loans, and when it comes time to exit, maybe they have like a really good assumable debt at that time with low interest rate, but the leverage is so low, because if their property is worth more, that leverage is naturally going to be lower, and it's not going to be attractive for the next guy to take over. So I had to think about that when we were going through. I'm like, all right, well, what is this going to look like on the exit? And how can we take advantage of this low interest rate that we're about to get? We didn't really know how low it was going to be at the time, but I'll get into that. But so we got it to 12. There was an option to take the loan from 10 years. So a 10-year fixed rate loan to 12 years. And the advantage to doing that is that Fannie would allow me to add a second supplemental on top. So I got one supplemental already, which in year 2 is going to allow me to take out my investors, you know, at least most of their funds. And then because I upped it to 12 years, Fannie said, you know what, that's enough time where we feel comfortable giving you a second supplemental for the next guy. So now I can get that second supplemental put on top of the other one. And I have a higher leverage point for the next guy to be able to assume our debt. And now our debt, the 10-year treasury was falling hard the week that we rate locked. So we actually rate locked at 3.48% interest on a $9.5 million loan on this deal. So that's going to be extremely attractive for the next guy to want to assume. Plus, we can now get the leverage up by adding these 2 supplementals on top of it. So that's kind of how we pieced together the debt in this deal, and we really were happy with what we were able to get.
No, that's pretty exciting. It's interesting you said the 3.48 because our group did a similar interest rate. It was actually the exact interest rate on another deal, and it was a Fannie deal too.
Awesome. Yeah, that's like such a win. You're just like, man, I've seen car loans that are more than this, you know?
So the question is, what did you guys originally underwrite the deal at? If you count it at 3.48,
4.3.
Yeah, we were at a 4.2. So when you start to look at the numbers and plug those in, it's like, wow, it really helps the cash for sure.
Yeah, it was awesome. It was such a cool thing to share with investors, like right away to get everyone excited about that. Is a great way to start off a deal with anyone, of course. So that was pretty cool. That's cool that you had the similar experience.
How many years of interest only did you get on that one?
We got 3 years interest only on that one, if I remember.
So I wanted to kind of touch on what you had mentioned a little bit in here as well about, you know, thinking about the exit in mind, because a lot of times we do get really excited about the acquisitions process and taking over the property, but we don't always look at and go, okay, well, we're taking over this property, but from a debt perspective, you know, where are we going to be able to, or who are we going to be able to sell this to, and what are they going to want to do from the debt perspective? Obviously, with that low of an interest rate, you know, any type of penalty or step down or defeasance or whatever would be fairly minimal, because 5 years from now, 7 years from now, the interests are probably going to be higher than that. At least that's what I would probably presume. So you'd have fairly little of makeup or yield maintenance you'd have to do there. But even with that in play, a lot of times we think, oh, well, I'm at 75, 80% loan to cost or loan to value right now. If I'm getting 3 years of interest only, they should still have plenty of proceeds, or they should still be plenty of, you know, leverage there for someone to be able to take it on. But what they're not thinking about is when you start to influence your value add play, and you're increasing the rents based on improving the community, then you've already increased the value of the property, which again drives down your loan to cost or your loan to value. So your leverage is going way down. And so you might be at 55, 60%, maybe even 65% leverage. And it's hard for somebody to be able to come to the table with that kind of that low of leverage and debt. And so to be able to have that option, like you had done there, to have that secondary supplemental loan that somebody can come in, assume the primary note, the secondary note, and then put on a tertiary note on there to be able to increase that leverage is just, it's a great idea that you guys did that.
Yeah. Just think about this. Like, who's going to come in? Like, I don't want to come in and buy a property at like 50% leverage. Why is the next guy going to want to do that? Also, it just lowers your buyer pool, and you're not going to be able to sell it for it as much if you're trying to not eat the prepay. I want to take advantage of this low interest rate that I got on an assumption later. Now, maybe the only disadvantage to the next guy is maybe they can't get the IO that I got, but if they can get into a 3.48% interest rate for the majority of the loan, now it's not going to be everything because you have to average in your supplementals, but it's still going to be a lot lower probably. I don't know, but probably will be a lot lower than where things may be 5 years from now. You know, I don't know how much lower we can really get on from where we're at. And honestly, like 2 weeks after that, Fannie, they had that whole cap, reaching a cap, whatever, for Fannie, they increased, they doubled their spread. So we hit it like at the perfect time. So that would, you know, that was just a kind of a clutch thing that we couldn't have planned for any better. And now, you know, being able to give that to the next guy is going to be very exciting as well.
How did you end up structuring the deal with investors?
Yeah, so we did a 75-25 straight split on the deal. We don't typically do a lot. You know, a lot of people prefer returns. We actually don't do that because we want the GPs to also be incentivized to make the property perform. So that's kind of the way that we have, our investors set up. So, everybody's different. I think some people like to do the preferred return for the investors. That's just not how we do things. But, we make sure that we definitely take care of everything. And we're buying very attractive cash flowing deals that can cover what we're putting out there for projections, and being as conservative as possible in the underwriting to make sure we definitely hit those numbers.
Excuse me. So there's 75-25 split, no preferred return is there more than one hurdle there in that waterfall, or is it just the one hurdle?
That's it.
Okay. So 75 straight, 75-25 split. That's it.
Mm-hmm. Yep.
Great.
Yeah. I've seen it a million different ways in the waterfalls. If you're using institutional equity or anything like that, they're going to want more waterfalls, but we try to keep it as simple as possible on this deal.
Sure. Yeah. No, I think it's a straightforward deal that you put together there. And how much of the 11.25 million purchase were you raising on the equity side?
This deal was 4.6 million we had to raise.
Okay. 4.6 million. And how did you, obviously, with the group that you're part of, and I don't mind, Garrett, if you want to mention what group you're part of or anything like that.
Yeah.
More than happy to do that.
Sure.
Where did you find your investors, and how did you communicate that, and what was the process like in raising the money for this project?
So my business partner is a friend of yours, as well as Michael Blanc, and there's quite a bit of a network that he's built up on his side. So he has a lot of people that are that listen to his podcasts, and that we keep in touch with a lot of his investors, and then they're kind of, they know, like, and trust him through the platform that's been built similar to the platform that you've built, and just makes it easier to talk to them, and they look at you as kind of the expert in the field, and when you can talk knowledgeably about the product that you have in front of you, in addition to the podcasts and all the other stuff that they've been listening to, I think it's a pretty easy sell to get investors into the deal. I think if you're partnering with someone, you got to know where your strengths are and where their strengths are, so that it's a good partnership. And I think I've always traditionally in the past have been, I do raise my own money as well, but I've been more the guy that is out there finding the deals, operating them, and acquiring them, getting them across the finish line, doing all that stuff, doing all the heavy negotiating. It's always kind of been my role. Like, I just like being in that, getting my hands into stuff and working things and negotiating. And I'm partnered with, some incredible guys that, Michael himself has a huge presence, and he has a lot of eyes on him. He focuses on the platform. Myself and my other, partner, Drew and Bronson, we focus on kind of the other side. Putting those two things together is a big win for us. And I think once we realize that, now we're ramping up the business and able to scale it even further.
So can you think of any other issues that might have came up throughout the entire process of this acquisition that maybe we haven't touched on yet, or that you think that might be unique to be able to bring up to discuss to the audience?
I think on this particular deal, it's just, one thing you want to always make sure of is that you're analyzing your staff that's on the property before you go into it. So you want to know exactly what you're getting, if you're keeping them, who's good, who's bad, whatever. I think that's pretty important. Is it the staff specifically, or is it just the owner that's not giving them what they need to do the job that they should be doing? But doing a real good assessment and analysis of that staff before you go into it, because if you do keep them on, they can help you a lot, because they've been on the property. They know all the things that are wrong with the property, or that they may need work. And I'm a big fan of, taking on most of the staff in the beginning, if possible, to kind of learn what's happened on the property in the past, and then seeing who's actually really cut out for this job. And because that on-site staff, and specifically your property manager, is so important to your success of your deal, your on-site manager. So if and you need obviously a large enough asset to be able to have that on-site staff, but I'm always a big fan of doing the bigger assets, because you have that on-site payroll. It makes it so much easier to operate these properties in general. So I think going into it, we had a really good understanding of who we had on site. We had our property management company that we worked with before go and interview everybody. This specific deal, we ended up, keeping everyone. But it's not always like that, but I think that was really important. And other properties doing, they're running really well. Everybody's doing their job at it. That's going to be a very important part into getting into any deal, because you got to think everybody's so focused on the acquisition, because that's like the glamorous side of things. That's the big glamour thing. But you actually got to make these things work after. I think people forget about that. And so any way you can set yourself up in the process to give yourself the best chance of success after you get the deal over the fence, is super important. And however you need to have that set up, and the amount of analysis going into that, I think, should not be underlooked. And, let's say you raise all the money in a couple of days and it's done. Well, let's spend as much time as you possibly can diving into the weeds in that property, understand every little nuance of what's going on with it. One thing I think we overlooked on this deal that we didn't know at all is that, and we found this kind of after the fact, is that we have half the property's boiler chillers, which are problematic in general. And we realized after that there was an entire building that was messed up, there was leaks, there was down units, air handlers, we had a lot of money allocated for this problem. And then after we closed on the deal, we realized that we could just shut down the entire boiler chiller, convert 2 buildings to individual HVAC, and the entire property would be more efficient, and it would eliminate all those problems and actually cost less than all the money we had allotted to just fix the boiler chillers and fix all those units. So that was a big thing that we found after the fact. We probably should have found before, to help dial in our budget, but it just ended up working in our favor. So yeah, I think there's not enough. You need to do as much in-depth analysis as humanly possible in those 2 months to make sure there's no surprises when you finally get it closed up.
So I have 2 final questions here for you, Garrett, and they're contrasting questions. So the first one is, what did you find during this entire process that was actually easier, but you originally thought that it potentially could be a little bit more challenging?
That was actually easier. Mm-hmm. I think the easier side was, I think, the transition. And I guess 2 things. Well, one was really just the investor communication and being able to, keep everyone informed on a regular basis. And I think we had like 50 investors or so in this deal. I thought that would be a little bit more challenging in general. Like they would just be hitting me with a ton of questions and all this stuff. And it would be, really, really tough, but it actually wasn't as bad as I think I had anticipated on that. So that, and then the, just the overall transition of ownership can always be a little bit tricky when people are uncertain if they're going to have a job or this or that. That went surprisingly smooth for us as well. So that was good.
And the last question here for you is what did you find was a little bit harder or more challenging than you had originally thought during the entire process of acquiring this property?
Yeah. So the harder thing, I think, was, for us, I think, was understanding the timing of the change of our brand, this deal. So we're completely revamping the name change and all that whole brand. And so in order to capture the highest level of rents, we need to have that name changed over. And in order to change the name, it has to be done at the right time, where the property actually looks different. So we have kind of this, this slim window of time where we need to get most of the exterior work done and make this place really look different. And I think maybe after closing, we could have gotten a faster jump on that. And I think, and then the next deal, making sure that we're doing the same thing, where it's like, listen, we're hitting the ground running day one, knocking out all this exterior stuff so that we can have that advantage of the new name, of the rebranding of the property sooner and achieve those higher rents sooner. So I think we're just a little bit delayed on that, but no, nothing too crazy, but that was something that was a little bit more challenging, I think, that we didn't anticipate.
So Garrett, I want you to tell the listeners how they can reach out to you and contact you, and maybe have a further conversation with you if they're interested in maybe furthering the conversation after today's interview.
Sure. Yeah, you can reach out to me. You can my email is Garrett, so it's GARRETT at Nighthawk, NIGHT, Hawk, HAWK, equity.com. So Garrett at nighthawkequity.com. And you can even, I don't even care if you want to shoot me a call, 630-709-8636 is my number, or a text. I'm easily reachable. If you guys have any questions, again, I've been doing this for a decent amount of time, and have a lot of experiences that have come my way. So happy to help with any of that.
Well, Garrett, I really appreciate you taking some time out of your schedule today and being with us and sharing all these golden nuggets throughout the entire podcast today, and looking forward to continuing to follow you and your group, and also having you on a future episode as you continue to close more deals.
Fantastic. Thank you, Dan, and congrats for you and all your success as well.
I appreciate it. Thank you so much, Garrett.